Wednesday, July 24th, Bank of Canada has decided to cut interest rates by 25 basis points. This marks the second meeting in a row the Bank of Canada has decided to reduce rates as they express concern around high rates slowing the economy and inflation more than necessary. The June CPI release, which was released on July 16th, showed a 2.7% increase in CPI year over year. Now that's down from 2.9% in May, which caused the markets to price in a rate cut. And the markets were right, and that rate cut happened. Bank of Canada cited that as we approach that 2% inflation target, we need to keep an eye on these high rates and cut if necessary, because undershooting inflation could be as concerning as overshooting inflation. From the latest job numbers, we saw unemployment rate shoot up to 6.4%, which is up 1.3% from just a little over a year ago. So it's clear that these rate cuts are making their way through the economy, through the market. You can definitely see small businesses struggling, people laying off, just less discretionary spending and more uncertainty around the economy, which causes people to just keep their money and not go out and spend it. Something to consider here is although the CPI data showed a 2.7% increase year over year in the whole basket of goods, shelter was still up 6.2%, with mortgage interest costs being up 22.3% and rent prices being up 8.8%. So one could argue that because shelter makes up such a big part of this basket of goods, Bank of Canada's elevated interest rates have artificially inflated the CPI and inflation numbers because of these high mortgage interest costs, high rent prices. And we're seeing a base year effect on mortgage interest costs. So in the fall, there is a potential that this mortgage interest cost increase goes down quite a bit and we undershoot the CPI and inflation targets, maybe a little bit more than some people are expecting. So all of this being said, how does this impact the market and how does it impact you as a buyer or seller? Obviously, Bank of Canada is not going to say what they're doing at their next rate announcement, nor do they know even if they were going to say, but it shows that rate cuts are definitely making its way through this economy. They cited that the US may cut rates and are expected to cut rates later in the summer or fall, which there is some concern around Canada cutting rates quicker than the US and then having a bigger gap between our overnight rate, which obviously devalues the Canadian dollar. So we're not at that point yet, as Tiff Macklem stated. Also, we have big banks and commercial banks now pricing in 50 basis points of rate cuts before the end of the year, whereas they were pricing in 25 before, between a range of 25 and 50. So they're hedging towards that more aggressive rate cut going towards the fall and winter of 2024. Since the CPI data came out and the rumbling of a rate cut on this announcement, the market has definitely got busier, in our practice anyways, with more people coming off the sidelines and more people wanting to take action and do things, because the consensus now around the market is rates are on their way down, and they may be on their way down quicker than normal, which a lot of people are happy about, but it really means the economy is struggling, right? So it's a double-edged sword. It's not just great because rates are coming down, but it's definitely felt busier in the market. As I've said in stats videos in the past, we kind of had a lackluster spring market, not a real spring market, but for the summertime, it feels quite busy. Things are happening, people are doing things, and maybe it's just because they're not off on summer vacation because they're not spending that money. But I predict that we're going to have a busier summer than normal, and that will probably carry into the fall and winter, especially if we see 1 or 2 rate cuts before the end of the year. First-time buyers are also coming off the sidelines with bond yields dropping, fixed rates dropping a little bit, so their buying power is going up a little bit. Maybe they can finally get into the market with these slightly lower rates. Also seeing investors come back into the market. I would say not so much in condos in the GTA, but definitely in our market, I feel like there's more people looking to make moves. Things are making sense. Deals are making sense a little bit more where prices are holding steady, but you're seeing lower mortgage interest costs. So that investment property maybe makes sense, especially if that investor is speculating that rates will decline. You know, the purchase right now may look good in 2 years if the thought is that rates will be lower in 2 years, which would reflect to prices likely being higher if all else is equal. So first-time buyers and investors come into the market. That feeds the bottom of the property ladder, which makes it way up. and then all these other people are able to transact and move. What does this mean for mortgage rates? Well, if you have a variable rate mortgage, you're going to see your payment decline. If you have a fixed rate mortgage, nothing will happen because your interest rate is fixed. If you're up for renewal, you'll see lower rates for variable rate mortgage, and you'll see lower rates for fixed rate mortgages because Bank of Canada reduced their overnight rate, which affects the variable rate. And after the inflation data came out on July 16th, we saw Canada 5-year bond yield, which fixed rates are tied to, drop to the lowest in 6 months. So when you're up for renewal, you'll see a slightly lower rate than you would have maybe seen about a month ago. The next Bank of Canada rate announcement is on September 6th. A lot may happen between now and then, but as it stands right now, it seems like the market is pricing in another rate cut. So we'll see what happens on September 6th. Thank you guys again for watching this video. Hopefully you found some value in it, and see you next week for a new video.